Guys, I just want to show you a quick video here on the difference between the RESP, the RRSP, and TFSA. So I don't know if you have any interest in this sort of thing. A lot of letters, a lot of weird stuff here. Let's start off with RESP. These are the one, two, three registered accounts in Canada. So you need a social insurance number to have one of these accounts. They are great because they give you free stuff, but they give you free stuff in different ways depending on what you're doing with the money and what you want to do with the money. So let's start off with RESP. That R is registered. This is education savings plan, so registered education savings plan. The thing about this is to save for going to school, for university. If someone opened one of these for you, you're in luck. If you want to open one for yourself, it's kind of too late. This is mostly for opening for your own kids, so you get a social insurance when they're young, and then you put money into these accounts. And if you put $2,000 into the account at any time, the government will give you $500. Okay, which is kind of nuts. No, that's wrong. $2,500. They'll give you $500. So they match 20%. So if you put $1,000 into the account, they will give you $200, and they just give it to you. You don't have to pay it back. Eventually, though, your kid will have to pay. You don't pay any taxes on that during the time when the kids growing up. So let's say you bought something for $1,000. You bought a stock of Apple for $1,000, and you sell for $2,000, and you made $1,000 in there, which is great. If you don't have it in a registered account, the government comes in and says, give me $200 or $250 or something like that, and then you're left with $750. Okay, if you have it in any of these accounts here, you don't pay taxes until later, or in one case, in the TFSA situation, you don't pay at all. So in the RSPs, they grow for free, and then you do pay taxes eventually, but it's later, which is kind of neat. But the main thing about the RESPs is that they give you free money. Okay, the government gives you free money to save for your kids' education. Okay, so that's RESP. Let's move on to our RRSP. RRSP is Registered Retirement Savings Plan. So this is something that you might want to look into as you start working, putting money into your RRSP. And this is really for retirement. So if you look at this situation, go, I don't want to save money until I'm 65 or 70 or whatever. You might not want to do this. You might want to go with the TFSA. But anyway, the cool thing about this is if you put money into an RRSP, the government gives you money off your taxes. So let's say you had a job and you paid $20,000 in taxes over the year, and they just took off money, income tax got taken off your paycheck all the time, and you went out and you put money into an RRSP. What they'll do is they'll come back and say, oh, you know what? You don't have to pay us $20,000. You can pay us $19,000 in taxes, and that extra $1,000 is yours. Okay. The calculation on what you get back is kind of complicated, but basically whatever you put into it is taken off the amount of money that you earned in the year, and then since they charge you income tax on that amount, they give it back to you. Okay. So not only do you get this for free, you get money back, so you get an actual income tax return of $1,000 in this situation. Which is great. So you get it right now. So if I go and I put in RRSP, when I do my taxes in April, right after that gets all settled back, I'll get my $1,000. Okay, so that's good. The other thing is that whatever you put into the account, just like that Apple example I used earlier, that $1,000 will not be taxed until later. So you buy something for $1,000, stock or something, it goes up in value to $2,000. You have $1,000 capital gain or whatever you want to call it. You made some money there, you make interest or whatever, you have $1,000 there. That doesn't get taxed until you're an old man or old woman and you take the money out. Okay, so as long as you don't take the money out, you don't get taxed. So it's RESP, but you do get taxed eventually though. These guys are different. TFSA. So TFSA is kind of neat. This is the thing that I think if you are going to save money, you want to look into TFSA. This is only for Canadians. What happens is you're allowed to put up to $5,500 each year into this account, and you never charge taxes ever on this. So if we look at that Apple example, from $1,000 goes up to $2,000, and you take the money out, and there's $1,000. You made $1,000. Okay, so you bought it for $1,000, you sold for $2,000, you made $1,000. You don't pay taxes on that ever. So not when you sell it, not when you take it out. You can do whatever you want with it. So let's keep looking at that, right? If I go from 2,000, I have $2,000 with my Apple account, right, or my share of Apple, and then I go ahead and I put it into a savings account, and I get $10, and later on, I take that and I buy some shares of or a mutual fund or something like that, and eventually it grows up to $3,333, and I sell that here and I make some more money. Well, every time you do that, normally you're going to have to pay taxes. So if I go from 2010 to 3333, I made 1323 on that. The government wants some money. I don't know what, but they want some of it. Okay, a couple $100, 300, 400, $500, but it adds up. If you put money in a TFSA, you never, ever, ever pay taxes. Ever, ever, ever. Okay. So if you're saving money, if you want to save money to buy anything, it makes absolute sense to save that money in a TFSA. Okay. So what do? You go to the bank and you say, I want to open a TFSA. And they go, no problem. All you need is a social insurance number. And whatever money you were going to save anyway, you put it in a TFSA and then you don't pay taxes. Okay. If you're just putting it in a savings account for a couple weeks and here and there and that sort of thing, and you're just saving money for a couple weeks or a couple months, that's one thing. Maybe don't bother with the TFSA. But if you want to save money for a boat, for a house, for anything, okay, or your retirement, even your retirement, or when you get older, you just want to be rich and retire at 50, you want to put in TFSA because you don't pay taxes. Okay. I'm gonna find some examples. I'm gonna be right back. Wait a second. Okay, so I don't know how that just happened. Give me a second here. 1 second here. What just happened? Okay, back to this. Okay, so I found this text for this thing here. So I'm gonna add the link to the bottom of this assignment. And how do I get this to disappear? Get out of here. All right, hold on. Okay, so this is Google. This is what I want. So this is CIBC calculator. Okay, so I live in Ontario. So like I said, I'll put the link in somewhere. And what you're going to do is you're going to put money into an account. And let's say what I'm going to do is every 2 weeks, I'm going to go ahead and I'm going to put away, I don't know, 25 bucks. Something simple. Okay. Now we can do more than that. What do you think? 50? 50 bucks every 2 weeks. Okay. And I put it in an account and I'm going to do that bi-weekly. So every 2 weeks. And I'm going to do this for 20, I don't know. You start working when you're 20 and you finish when you're 50, let's say. So 30 years. And you look at this and we're going to have an interest rate of, or annual return rate. So not interest rate, but let's say I can go ahead and I can put this in mutual funds or something. We can talk more about that at another point. But if you go ahead and you buy a mutual fund or an ETF or something simple, okay, you talk to the guy at the bank, they'll help you out. And let's say you get 6%, which is not that much. It sounds like a lot, but that's about what you get on average. Some years more, some years less. So let's leave it at 6. And if I did this and I put it into a regular account, over here, you see that I would have $75,000, which is great. Okay, great job. But look what you would get otherwise if you put in TFSA. Put in TFSA, you're going to get 105,000. Okay, so I'm not that good with math, but that's $30,000 different. Okay, so $30,000, and there's no difference. You didn't do anything different. You didn't work more. You didn't do anything different except that you opened up a TFSA account. So $30,000 disappears to taxes if you don't open a TFSA account. So this is a newer thing. I lied to you. I said that the most you can put in each year is $5,500. It's 6,000 now. So it's moving up. It's moved up. It was 5,000 and it went up to 10,000 for a second there, but it went back down to 5,000, 5,500, and now it's 6,000. If you can do more, so if you go, wow, that looks great. Well, let's extend this a bit here. So 30 years, that's a long time, but let's make it 35 years. Okay. So you're going to retire and you can bump that up. And let's say, let's just make it easier. Let's go per year. No, let's say bi-weekly because you're going to get paid bi-weekly. Let's go to $100. Watch this. Look at the difference here. 88. Yeah, you know what? Let me just type it in. 100. Look at this. Ready? 298,000. But the big thing is this. Look at this. 298,000 versus 199,000. You don't pay taxes on this $100. So on the left here, you have a great amount of money that's saved. Good for you. You saved $200,000, close to $200,000. That's amazing. Okay, you do some great things with $200,000, but you could have almost $300,000 if you would just open up an account. So what you do is you go to the bank and you just ask somebody at the bank, somebody who works there. Okay, don't just ask a stranger, but ask someone who works there and say, hey, how do I open a TFSA? And they'll say, go over one of these things on the side there and open this up. You buy a boat, you make 200,000, you make 300,000, you buy a boat with that money, you call it lupos, and you live a long, happy life. Okay, so that's a TFSA. They're great, and that's that. Okay, see ya.